Good morning, everyone, and welcome to the second episode in our summer series of Skipton Talks. My name is Derek Adams, National Account Lead for Skipton Building Society for Intermediaries. I've unmuted, so that's always a good start. And so pleased to see how many have joined us this morning. We're really appreciative of the fact I think the demands and time of brokers at the moment is really tight. So really pleased to see so many join us, and hopefully we add a bit of value for the time you spent with us this morning. For those of you who perhaps haven't been on with us before, there is a chance to be interactive. So there's a chat bar on the right-hand side of your screen. You can chat to us, ask any questions. We're hoping to have a bit of time at the end for any questions raised. You might just want to say a quick hello. We're conscious that affordability and cost of living is such a hot topic at the moment, so you might just want to leave your opinion on there. Em and I are really keen to just keep the conversation going. There's a lot of moving parts out there in the industry. If you wave your mouse over the screen, you'll notice you can pause us and add subtitles to if required. And that I won't take any offence because of my accent if you put the subtitles on. So I'm delighted to be joined by Emma Hill this morning. Emma is one of our BDMs out in the field. She's been with Skipton 10 years, the last 5 of those in her role as BDM. The previous 5 to that, Emma worked in a number of support roles within Skipton, and I think gives a really good insight as to what's happening there out in the field, but also great insight with regards to making sure our proposition is good as it can be. She's part of a number of working groups that feeds in from the coalface just to make sure our proposition is fit for purpose in the intermediary market. So good morning, Emma, and welcome to your first ever Skipton Talks.
Good morning. Yeah, no pressure there. So firstly, I'd just like to echo Derek's comments in thanking you all for joining us this morning. As Derek has mentioned, I'm one of the field-based BDMs here at Skipton, and I'm sure it's fair to say that the cost of living and affordability really is at the front of most people's minds at the moment. Today, our webinar is about having a conversation with you about the cost of living crisis that we're facing, and more specifically, what Skipton are doing to address affordability as a general subject. I think it's important to add at this stage that any views or opinions given in today's presentation are those of Derek and I. For the next part of the presentation, I'm going to pass back over to Derek to take a look at some of the economic stuff, which really is not my bag. Next slide, please.
Thank you, Emma. Yeah, I've got the economic stuff, and we've got economic variables, and I think the key to say is, the difficulty at the moment is not so much, well, it is the factors that are out there, but there's so many moving parts. So Emma and I decided to look at what we would call the main ones this morning. So maybe a few stats and figures for you, but hopefully it gives you an idea of what we are seeing at Skipton and where we think things are going. Starting with the obvious one, the Bank of England base rate. If we were having webinars years ago, we would have had nothing to say because it just didn't move. I'm on a lot of panel debates, and a staple question from the panel debate is what's going to happen with interest rates. And thankfully, I've got colleagues in Treasury that make sure that I'm pretty much close to the mark. But you'll all have seen, even in the recent meetings, it's not so much what if there will be a rise, now moving to what size will the rise be. And I'm sure everyone on the call at the moment is aware that the Bank of England need to balance the need to control inflation without harming the growth prospects of the economy. Increasing the base rate makes it more expensive for businesses and consumers to borrow money, hence reducing the demand for goods and services, and in turn controlling prices. We're going to move on to inflation in a second, but we've all heard the Chancellor stating that he'll use every tool at his disposal to try and curb inflation. And we all know that the Bank of England interest rate is a big lever for him to pull. The graph is showing maybe a projection there. I think the market expects the Bank of England base rate to rise anywhere between 3 to 4% between now and the end of 2023. Ourselves at Skipton, I think we're slightly softer in that we currently expect base rate to peak at 2.5% in December 2022, and then gradually return to 1.75% by mid-2024. So rates rising, generally speaking, when I'm looking on social media and my broker friends, we're starting to talk about rates that begin with a 3 rather than a 1 or 2 that was previous. And I think what will be interesting is this increase in mortgage costs. How much dissuasion, if you like, will that stop second-time buyers deciding to move? Also, there's the anomaly now with perhaps the difference between product transfers and remortgage, people coming off deals which would have been a lower rate than they had before. So interesting times, and one certainly to keep a look at. We're now going to move on to inflation. Consumer price index, and again the graph doesn't need to show where that has been going. Again, if you've been to any recent events, speakers there have been trying to predict where inflation is likely to go, and a few of them have stuck their neck out to say that without going into specifics, they reckon it's going to be double digits. And as you can see from the graph, it's been unprecedented as far as this side of the millennium. The annual inflation rate in the UK has increased to 9.1% in May from 9% the previous month, the highest since 1982, and in line with market expectations. I think it's interesting though to break that down with regards to the different aspects of CPI. Cost accelerated for housing and utilities was actually 19.4%. Transport was 13.8%. Food and non-alcoholic beverages 8.6%. Furniture and household goods 10.5%, and alcoholic beverages and tobacco 5%. As you can see, some of those way over the average of the mix or basket of goods. CPI inflation is expected to be over 9% during the next few months and rise to slightly above 11% in October. The increase in October reflects the higher projected household energy prices following a large additional increase in the Ofgem price cap. We all know, and again, it's one of those tangibles we're all seeing, our fuel bills coming through the door and seeing the difference that that's making. And just a slight aside, for those of you like me who like their examples in layman's terms, the average price of a pint is up 9% year on year from May last year. I wanted to add in there, it's a sobering thought, but Emma wouldn't let me. Moving on to unemployment. There was lots of projections during lockdown and follow, lots of people trying to predict what potentially unemployment could go to. You can see the spike there in sort of lockdown, but actually some of the predictions, maybe erring on the cautious side, haven't materialised, and it's starting to be fairly level. The jobless rate in the UK edged higher to 3.8% in the first 3 months to April 2022, from 3.7% in the 3 months to March. It is the first increase in the jobless rate since the last 3 months of 2020. And payroll employees were up by 90,000 to a new record of 29.6 million in May. And job vacancies in March to May rose to a new record of 1.3. However, the rate of growth in vacancies continued to slow down. What's underlying this, although, I think for ourselves in lending and brokers, is actually how it's affecting earnings at the moment. And the average weekly earnings, including bonuses in the UK, increased by 6.8% year on year in April 2022, below 7% in March, and much less than forecasts of 7.6%. Regular pay, which excludes bonus, went up by 4.2% in the same in previous quarter. I think the key thing for me though is if this is adjusted for inflation, the growth in total pay was only 0.4%, and that's the biggest drop since 2011. Continuing to point to further squeeze in UK living standards. And considering the April month only, average real earnings, excluding bonuses, were 3.4% lower year on year, the biggest drop since records began. And therefore, a couple of slides, first couple of slides, we're hitting ourselves in the pocket as far as costs, and there is some trends out there that suggest that there could be a squeeze in living standards because of actually taking inflation into account. Earnings, basically your pound isn't buying as much as it used to. I think just to add to that, we'll have all seen last week, Britain got its biggest rail strike in 30 years with the walkout of train staff, joined by the underground. And this is not very scientific, but certainly from myself and social media, I saw a large groundswell of sort of public support for what they were doing. And I think it'll be really interesting to see how that pans out, because there are other industries that are also considering strike action, including schools, hospitals, airports, telecoms, waste collection, post offices and buses. So again, an awful lot that could change over the next number of months. If we then move on to fuel prices, you'll probably see the remark, that's the one slide that I didn't put together. You'll see the rising costs of energy prices, but as you can see, they've steadily increased. But I think if you look at the bar on the far right, that is the summer price cap equivalent, and the price caps that have only gone in and the future ones coming are going to be the huge difference that people are going to see. Many observers predict that the price cap will increase further in October 2022. The chief executive of Ofgem said it could rise by 40% to around 2,800 in October. and other forecasts of increases vary from 30% to 50%. The price increases that consumers have already faced have led to concerns about the impact on vulnerable households, particularly those in fuel poverty who might not be able to heat their homes properly. There's some really concerning stats about fuel poverty. Ofgem said that 12 million households, not people, 12 million households might end up in fuel poverty. And the energy company E.ON estimated that 40% of Britons may fall into fuel poverty later in the year. And I think it's quite interesting, the definition of fuel poverty is defined differently in different parts of the UK, but it broadly means having to spend a high proportion of household income on keeping the home at a reasonable temperature. But I think what's really interesting is that you can't be considered being in fuel poverty if your property has an energy efficiency rating of C or better. So therefore, regardless of the income that you have, if you're in C or better, you will not be classed as being in household poverty. So in 2020, there's 2.6 million households where they were in the bottom two income tiles, but were not deemed to be in fuel poverty because their property had a rating of C or better. So therefore, the stats we're seeing, it might even have a higher impact than we're perhaps maybe anticipating. And finally, the one slide that I didn't put together just because it was changing almost by the day is the petrol and diesel costs. You know yourself, if you've gone to the pump, we saw the hard-hitting stat that the average car now has tipped £100 to fill your car. And again, another example where people are now actually seeing a tangible difference. When we talk about inflation, petrol and heat, and I suppose even just the cost of staying alive, people are seeing those actual intangible terms. So I'm going to bring Emma in now, because Emma, you and I thought a few weeks ago putting this together, we were seeing this, what I would call this heady cocktail of various factors that are out there. And I think it's fair to say that both of us were surprised last week when the Bank of England made their announcement with regards to affordability rules.
We were, yes. If we can move on to the next slide, and we should probably give a thank out to the Bank of England for giving us such a timely announcement just in time for our webinar. It certainly is an interesting one. I've had a couple of conversations about the article with brokers and internal colleagues over the last week or so, and there seems to be some real confusion about what the desired outcome of this move really is.
So I think the obvious question for me and everybody listening is that the Bank of England made this announcement last week. They've come on to a Skipton webinar about affordability. So let's get this question out. What's the Skipton approach to the announcement last week?
Well, it certainly caused a mix of responses in the market, with one calling it utter madness. Apologies if I've missed anything, but I don't recall seeing anything to the effect that any lenders have made a move with this as yet. From Skipton's point of view, we won't be making any groundbreaking affordability moves off the back of it. As a lender, we currently work with a discounted reversion rate, which means that all of our existing products sit outside of the rules, or the rules that were. Therefore, the removal of that 3% requirement will have no bearing on any ongoing affordability assessments or conversations. But what it does do, however, is potentially present an opportunity for us to review our approach against discounted reversion rates in the future. It really will be interesting to see how others react to this news over coming weeks.
Well, that's obviously our stance. What else are you seeing there, just in general, about affordability in your sort of out in the field, the patch that you cover?
Yeah, so you've touched on interest rates, and they really are a biggie. Derek's provided some of our own insight this morning, and whilst these are opinions of ours, I think it's fair to say that we will continue to see some shifts in the upwards direction, certainly over the short term. And as Derek has said, for how long have we seen these adverts about getting a better deal on your mortgage? And for some of us, this will absolutely be relevant, but for many others, it's not going to be the case. And that's a conversation that you as brokers probably have got out of the habit with having with customers. There's also some debate out there about longer term fixed rates. Over the last couple of years specifically, I think it's fair to say that brokers have seen a real benefit in managing the back book and repeatedly reservicing customers. So there's some discussion about how to plug the gap of income generation when tying customers in for longer fixed terms. And just going back to conversations with customers, an observation that I've personally made is that brokers seem to be spending more time and being more thorough with personal budget planners, making sure that these really are a true reflection of customers' financial circumstances.
I think that's a really good point, because I spoke to a couple of brokers myself who are saying, you know, whilst we don't, it's horrible to see costs going up, but it does focus mind. Customers now see the relevance of bringing in accurate budget planners, and it allows brokers to actually have a proper conversation about their budget. So more than just mortgage, making sure the finances are in check. I'm going to move on now to our affordability calculator, because I always talked about budget planners. Our affordability calculator, I've always said it meetings, etc., that it uses ONS data, and people can see on the screen that we just asked where the region of the property is. But I think, is it fair to say that it takes into account more than just ONS data?
It sure does, Derek. So you're correct in saying that the calculator itself is based on ONS data as a basic structure, if you like, rather than a full budget planner style calculator that some other lenders use. But what we do is incorporate the latest ONS data into the calculator, but it's then supported by various algorithms put together based on the economy and other internal and external factors such as LTI limits, legislation, rules, etc., in order to give a realistic lend.
So obviously, I went through the stats. There's obviously a number of factors out there. We talked about the latest ONS data. So I suppose for those listening to our webinars, what assurances can you give them that if they're putting a calculation in our calculator, that it currently reflects what people are feeling in their households at the moment?
Yeah, so one thing that makes me really proud to work for Skipton is how financially strong we are as a business. The decisions that we make are always about doing the right thing for our customers and making sure that they're offered the best product for them, whether that be in mortgages, savings, or even financial advice. In terms of the calculator itself, we have a team within credit risk who specialise with the calculator in order to make sure that it's A, reviewed frequently, and B, that we're able to act quickly to ensure that changes in the economy are reflected within the calculator. I'd also say that it's forward-looking. As a development team, we work closely with all parts of the business with the feedback that we get from you, the brokers, the cold face as we call it. And ultimately, we want to provide mortgages to your clients that are affordable for them, reflecting the true cost of living. Next slide, please.
So I think to recap then, we've went through those factors at the beginning of this sort of webinar with basically all the different factors that are contriving to make it a really difficult time for potential customers, for potential borrowers. We've also looked at the if you like, the restrictions that lenders have to be based in the factor. It's a decent affordability calculation. So I've asked you this morning to come along and maybe talk about some of the things that we've changed on the basis of broker feedback, some of these enhancements we've made to our proposition that's going to help with affordability.
Thanks, Derek. Yeah, so I've put together a slide on some of the key areas that I talk about with my firms. I am conscious of time and I'm not going to go through them all in absolute detail. So please do get in touch with your local BDM, telephone BDM, if you do want to discuss any of these subjects further. But what I do want to do is highlight some of the things that we have already done to address some pressures on affordability. So the biggest move for us significantly would be our joint borrower sole proprietor proposition. Since we've launched this, it really has grown arms and legs. Initially, when we were having these conversations, the concept for us was the idea of mum and dad helping out children to get them onto the housing ladder. But as we didn't end up restricting it to family members, we've seen it used in many different scenarios now, whether that be friends helping, employers, ex-spouses. So just a few key pointers for me. So we can use up to 4 incomes, and it doesn't matter what the split is in terms of borrowers versus proprietors. You could have one person on there that is going on the true mortgage and deed, and you could have another 3 coming on just to help out purely for affordability. You don't have to be related. It can be used on purchases and remortgages. And we can go up to 95% with the proposition. In terms of the joint borrower sole proprietor as a subject, we did actually run a podcast on this as part of our spring podcast. I think the link is going to go into the chat bar. So if you are interested in having a listen to that, where we just discuss some of the times that it would be relevant, by all means, please follow that.
Just a quick one from me, Emma. It's going down really well when I'm out and about. One sort of challenge we've had is if someone is using it for mum and dad helping son or daughter, mum and dad will tend to be of an older age, which might restrict in the term that we can provide. Do you know if some of that feedback's gone back?
Yeah, so that is correct. So that's probably one of the biggest pieces of feedback, or I'd probably say that the only negative piece of feedback, if you like, that we've had about the proposition. Obviously, as a lender, we have to be realistic in terms of where we take a mortgage to. However, we do understand, and from your feedback, we do, you know, the part of the proposition is that you hope that mum and dad are going to come off at some point. So we are taking that on board. We've had many conversations about it now. Hopefully things are moving in the right direction with it. So just watch this space in terms of that specific feedback. But hopefully that does give you a sense that, you know, when we launch something, it might not be all singing, all dancing, and your feedback really does shape how that looks in the future. So please do continue to provide feedback for us. Just a couple of other things in terms of affordability and where we're at. So we've slightly changed our stance on P60 income in the respect that if you have someone that is in receipt of regular overtime bonuses, that kind of thing, and by regular we mean that we want to see it on pretty much every pay slip, we can now take 100% of that income with that 12-month record. So if you've got someone's P60 and you're happy to say, do you know what, it is regular, we will take 100% of it. If it's non-regular, we can still take 100%, but we still need those 2 years worth of P60s. We've also increased our loan to income multipliers, so we can go up to 5 times income on a repayment basis where the income is over 80,000, and up to 4.75 times for 90% loan to value. One of the most recent things as well is that we have increased our maximum term up to 40 years. So that's gone from 35 up to 40. Again, just hopefully giving that extra little bit of stretch when it's needed. Next slide, please.
Thank you, Emma. Some good stuff for hopefully, as you made the point, whilst there are restrictions to affordability, there's a few enhancements we've made there that allows maybe a broker listening to get to maximise the affordability we can provide. There's been lots of questions piling through, some of them just some feedback to some opinion which we asked for, so that's all good stuff. I'll pick out a couple of maybe quickish ones that we can answer in the time that we've got left. Anonymous has asked, joint board or sole proprietor, is it a maximum of 2 households?
It's not, no.
Here's a fairly simple answer. I think the affordability calculator does offer 4. Yeah. So there's a very quick answer to that one. There's a question on as well from Anonymous. You talked about P60 income. What we're looking for evidence-wise for someone that perhaps gets additional income over and above their employment, the salary?
Yeah, so typically we ask for P60s, and sometimes you do get from brokers, you know, especially when you're sort of at the moment P60s are pretty readily available because of the time of the year. But as we move down the year, you do get a little bit of resistance around P60s. But what I would say about our P60s is that it really opens up to seasonal working. So if someone does have overtime or commission that is more seasonable and isn't on the last pay slip, by looking at the P60 figure, we're not saying, right, okay, so you put the traditional income in, but we can't actually see it on the pay slip that you've sent us. We're not bothered about that. We're looking at what did you actually take home year to date as your earnings for the last year. And as I've said, if you can evidence something, you know, if someone's getting that income month on month, we can take 100% with that one P60. If not, we'll need 2 years P60s to evidence, and we'll take 100%. And if you've actually just got someone that's just got 3 months worth of pay slip showing a little bit of overtime commission, still annualise those 3 months and pop that into non-guaranteed, and we'll take 50% of that for you.
Good stuff. I'm just, as I say, trying to pick out ones that perhaps we can answer fairly quickly. There's a lot of really deep questions sometimes, maybe more for the Chancellor, but we'll take those on board because we did ask for opinions. question maybe that was being triggered by is talking about mum and dad's age. So there's a fairly straightforward question of what's your maximum age? So maybe you want to just clarify what Skipton would assess as being someone's maximum age.
Yeah, so there's a couple of different answers to this, dependent on where you are. So if you are outside of 10 years into retirement, and Skipton's blanket retirement age is 70. So if you're 60 and under, and you are paying into a pension and can evidence a pension contribution, doesn't matter how much that pension contribution is, we can lend up to the age of 75. If you are within that 10 years, so if you're 60 and above, we'll be looking at your pension earnings. And if you are already retired at the point of application, then we can take you up to 80. So for example, if you've got a 55-year-old that's got a good pension pot, already retired and using that, we can go right up to 80 in those instances.
Thanks, Emma. I'll probably just a way of sort of summarising and finishing. There's some really good feedback about rates, various things. There's a really good question about plans to bring LTI up to help first-time buyers who may be able to buy a suitable house at a cheaper monthly cost on the mortgage than it would be to rent in light of the cost of living crisis. And I think that's a really good point. There is some discussion within Skipton. If someone can show that they can afford a track record of paying rent, then there should be something we could do if we can put them onto, let's say, a mortgage, which would give them a lower monthly payment. So I suppose for those listening this morning, you have my assurance that Em and I work closely with our products team, our credit risk team, our new lending team. So I think it's given us a lot of food for thought this morning. We really appreciate both. Great to see the numbers on here, and also great to see the comments, and we'll assure you that each and every comment will be taken on board, because it might allow us to shape some of our thinking going forward. I would just like to thank Emma for coming along this morning fabulously on her first Skipton Talks. Again, she made a really good point. If you've got any feedback as well through your local BDM, we'd love to have that. Certainly myself and Rachel through your clubs and networks would also welcome any feedback through that as well. Moving on to future episodes, so the next few weeks you can see what's coming up. We'd encourage you to register. You can register for all of them on our Skipton Talks page, and really looking forward to seeing those webinars coming up. Shameless plug, but Rachel and I have also recorded, as Emma's alluded to, some podcasts on things like joint borrower sole proprietor. So again, if you like podcasts where you can listen to the car or having it in the background, we encourage you to have a listen at those as well. Just finally from me, it really is a big thanks for you all attending. We like to make these short, sharp webinars so that you can then get back on your day. Hopefully it's added some value this morning. We'd be happy to take any feedback as to how we can make those forward. Our plan for this is always to be talking about what you as a listener want to hear, and we'd happily take some feedback to shape those going forward. So thank you everyone for attending, and I hope you all have a great day.
Thank you very much.